Hi everybody. So on this discussion, we're going to do the difference between gross price method and net price method. And this is fairly new in the accounting world. So this may be, you may be used to the gross method, but you may not necessarily be used to the net price method. So what we have here is Decker Corporation. They sell merchandise with a list price of $15,000 on December 1st. With terms 1%, 10, net 30. So if they pay a net in 10 days, they get a 1% discount. Otherwise, they pay it off in 30 days. On December 10th, they made a payment of $8,000 and $4,500 was received on December 31st, 2016. So using the gross method, what we wind up doing is we have accounts receivable for the $15,000. And we have sales revenue for the $15,000. Okay, just the traditional account that we're used to seeing. We're going to say we are periodic, so we're not going to worry about our cost of goods sold and our inventory. So on 12/10, they get the discount, and so when they pay us, they're going to reduce it by the amount of the discount. So this is going to be, they paid $8,000, and we're going to take the $8,000 times, let's do the times, 0.01. So what they're doing is they're going to be mailing us a check for $7,920. Now, in things that you were used to in the past, we would have used the account sales discount. Well, sales discount is no longer an account that we use. You may or may not run across this, okay? What we're going to wind up doing is we're going to reduce our sales revenue by the discount, okay? So I'm going to take my 8,000 times my 0.01. So I'm going to, here I had revenue of $15,000. I'm going to reduce that sales revenue by $80. We're still going to reduce our accounts receivable by the $8,000. So these two equaled $8,000. Our debits and our credits still equal. So then they paid $4,500 on December 31st. They are past that 1% 10 day, so they will be sending us a check for $4,500. I went ahead, I thought I would be helpful, especially when we get to the next method. I'm just going to, we originally billed them for $15,000. We received money of $8,000, and then we received money of $4,500. So we have a balance of $2,500 that's open. Now let's see how that compares to the net price. So net price method, we are going to assume right away when they make that sale that they're going to take that, just that 1%. They're going to honor that 1% 10 and not pay it in 30 days. Okay? So when we're doing that for the net method, we need to already assume that they're taking that discount. So this is a new process. This is fairly new in the accounting world with the merger of FASB and IFRS. So 14,850 is what we are actually going to put in our accounts receivable and in our sales revenue. So then what happened here on December 10th, they took the discount. So that one is the same. We do the, they paid $8,000. Well, let's get this parenthesis. Oh, my hands are not working right here. 8,000 times the 0.01. Oh, well, okay. Yes, I hear you. So cash for $7,920 is what we're going to reduce. Okay, we've already dealt with the sales revenue. So now we just have cash. And notice on our accounts receivable here, we did the discount already. when you did gross method, remember you put it in for the gross amount. Here we're putting it in for the net amount. So then when we reduce our accounts receivable, it's also going to be based on the net amount. Here comes the fun part. So December 31st, they paid $4,500. Well, that is past the discount period. So they will be giving us $4,500 in cash, but this is where it comes in here is we will take the $15,000 that we originally billed minus the $8,000 times 0.01. Well, let's put an equal sign in front of that. How's that sound? Okay, so we are going to gain, remember sales revenue has a credit balance, we're going to gain $70. Because when we first originally did this, we assumed they were taking that full discount, so we discounted the sales revenue also by that 1%. They didn't take it. So then we get an additional $70 added to our balance. So then we can just, remember our debits have to equal our credits. So now we will reduce the accounts receivable by the $4,430 because we also had originally put that in there at a discount period. So if you remember what I did over here on account, they still have $2,500 left that is open for them to pay. December 31st comes along. We need to reconcile the account for any amount that the discount was not taken. $2,500 was not taken, so we can take that $2,500, we can take it times our 0.1%, and then that gives us what the accounts receivable, we're bringing it back up, and we are increasing our sales revenue by the $25 because, again, here with the net price method, we assumed they were taking the discount. So we went ahead and did the credit for sales revenue at discount. Here we were able to increase our revenue by $70. Here we were able to increase our revenue by $25. We're making that adjustment. I know you will have several examples to go through when you're completing your homework, but I hope this helps to kind of give a strong idea of what the gross price method is versus the net price method.